In fact, I've got Jim O'Neill with me from Goldman Sachs Asset Management, and he says that the Ambrosetti Forum probably should be held outdoors because it is that beautiful here at the moment. I have Jim O'Neill, as I mentioned, also Nouriel Roubini from Roubini Global Economics. Thanks, guys, for very much coming to speak to us. I wanted to start talking about the firewalls because the finance ministers, obviously, they're meeting in Copenhagen. Let's assume that they do come up with a firewall. Wolfgang Schäuble is talking 800 billion euros. How does that fit in with the end game for the debt crisis? Also, does it just buy time for adjustment?
Well, I would say the firewall, of course, at the margin helps, as well as the actions of the ECB. But the fundamental problems of the Eurozones are of stock problems, stocks of public debt and private debt that are excessive, and flow problems, lack of growth, actual recession in the periphery, lack and loss of competitiveness, and also large external deficits are not financed anymore by the private sector. Those fundamental problems cannot be resolved only with liquidity. There has to be a real restructuring and or eventually debt reductions as well.
But Jim, do you think that there is any of these problems are being addressed? I mean, we do see reform happening in Spain. Something's happening also in Italy.
Yeah, well, I kind of agree. You know, Nouriel and I often have different views on some matters, but on this, I kind of agree. They've got to shift their attention away from just austerity. There has to be something to get more broad growth, or it's going to be a perpetual problem and we'll have to dream up some other thing. With it, I do personally think that Italy is showing signs of genuine structural reform, but that for the others, there are so many ongoing problems. It's difficult to get away from it. You know, to see at some point in the future that's the end of the problem. It's tough to see.
I was just talking to Richard Koo from Nomura just an hour or so ago, and he was also talking about the need for stimulus and how austerity is obviously not the answer. But where and how do you stimulate an economy when you've got already such problems with deficits and also debt?
Well, in the short run, the fiscal austerity, however necessary, reduces aggregate demand, reduces disposable income, makes the recession worse. In my view, you need a significant nominal and real depreciation of the currencies in the periphery of the Eurozone. There are only four ways you can achieve that. Either the value of the euro falls sharply. Germany can live with a euro at 1.3 being uber competitive, but for the periphery, where unit labor cost rose 40%, you need the depreciation. Second option is structural reforms to increase productivity growth. It took 10 years for Germany to do that. The third option is deflation, internal devaluation, but that leads to a more severe recession. So if you cannot either grow yourself or devalue yourself or deflate yourself to real depreciation, eventually for some country, exit from the Eurozone could be the only option, one that's going to be very damaging, but the only one. So we need a nominal real depreciation to restore competitiveness, to restore external balance, to restore economic growth. That's what happened in most emerging market crises. There was austerity, there was structural reform, there was a significant change in relative prices as well.
Do you think that's the answer, Jim? The depreciation of some Eurozone currencies?
I mean, the easiest solution of all those that Nouriel outlined is really a depreciation of the euro. But the dilemma they face there is that many other parts of the world want the same solution. So we can't, you know, it's a bit of a, as it's been for a while, a game of the least ugly sister amongst the major currencies and countries. And so the only practical alternative short of exit is for some deliberate policy-induced easing of financial conditions. You could get some support if there was a permanent sizable drop in peripheral bond yields. And of course the LTRO has had until recently achieved some of that, and it'll be really interesting to see the ongoing data for the next couple of months. That there's a hint that Italy is stabilising, but you know, we do need more than that, and short of something coming from the rest of the world as an external stimulus, it's tough to see a lot of growth in Europe. It's tough
then
to
are you
see.
looking, but to see that depreciation of the euro, I mean, are you looking for some further stimulus from the European Central Bank? You know, outright more buying of government debt?
They always seem so reluctant. I mean, as soon as you get a bit of life, they start talking all hawkishly. You know, there's so many issues at the core of it. If these countries aren't going to face even the austerity that they're guided and encouraged to do, the Germans should really accept a higher inflation rate. The ECB can't hit a 2% inflation rate if Germany's trying to keep theirs at 2 and everybody's lower. But you talk about that with German policymakers and they look as though you come from another planet.
How do you see the outlook for growth or in Europe? I mean, are we looking at a recession this year for all of Europe?
Well, not for all of Europe, but certainly the periphery of the Eurozone is in a recession. Now the latest data on PMIs, even for Germany and France, suggests that there is a slowdown of growth close to a stalled speed. In my view, this recession is not going to go away. First of all, the fiscal austerity is recessionary. Two, the euro is too strong. Three, there is still a credit crunch in the periphery, not in the core. And even if liquidity doesn't resolve the problems of capital of the banks. Four, oil prices are rising, and Europe depends on oil even more than US, where you have half of the demand coming from domestic production. And now there are all these political uncertainties, the French election, the referendum in Ireland, the situation in Greece with other election, and now resistance even to austerity in places like Spain. So these are also fundamental reasons why recession in the Eurozone can continue for quite a while.
Not looking good for Europe, but let me just ask about oil prices, because I'm just interested to know, we're going to see the increase of oil, the prices, obviously that's going to mean money flowing into the Middle East, flowing into Norway, the producers. Where do you think that money is going to end up, and what would be the impact on exchange rates?
Well, to just round it all together, the European thing has to be put in context. I mean, the world isn't driven by Europe anyhow these days, so I think Europe is in a recession, but that's not the world. On the oil thing, I have a slightly more controversial view that I'm not convinced oil prices are going up further. Yesterday there was a very interesting interview in the FT with the Saudi oil minister that made it pretty clear that they wanted to, if necessary, deliberately push oil prices down. And given the politics that's coming up in many parts of the world, not least the US election, I think this notion of some deliberate oil selling from strategic reserves is something that might happen. Because I don't think the underlying supply and demand is as strong as the market professionals say. Look, I follow the long-term oil price very closely, and that's not risen at all the past 2 years. So there's a huge gap opened up, which suggests to me some of the rise is about speculative demand or hoarding, probably linked to the never-ending Middle Eastern speculation.
Nouriel?
Well, I do agree that actually the rise of Brent from 90 to closer to 120 or above is mostly explained by this fear premium, given the rising tension between Israel, US, and Iran. And there is certainly room for maybe the Saudis to increase some production and for maybe eventually the strategic reserves to be used as well. But the fundamental problem is that if those tensions in the Middle East are going to be rising further, we don't know, it's possible, then even if there's going to be use of these other supply sources, that fuel premium can go higher. So it depends on a geopolitical factor that we don't know. We don't know what's the probability there's going to be a military confrontation. And even short of that military confrontation, the war of words is rising, the covert war between the two sides is rising. That fuel premium could go higher and increase all prices regardless of those underlying fundamentals that Jim was talking about.
Just looking back at what would be the global growth driver, if you had to name one country, would it be China?
Well, actually, the forgotten one, I think the US is going to continue to surprise for the next couple of quarters.
Are we looking at something sustainable there?
There's a couple of big structural things which, the US has got the same aspects of the delevering problem in other places, but there's two big structural positives linked to why I have the view I have on oil. The US, the shale gas thing is a big story, and I think it's helping quite a lot of industry think a lot more positively about the US than has been the case possibly in a generation. People like DuPont and Dow Chemical have actually publicly stated this, and you see evidence of it, and this is partly why job growth is picking up. It's not for more normal reasons. This is a bit of a new phenomenon for the US. And then in addition, I think the housing market is turning in the US. So I think that the US has got some legs at least for the next couple of quarters. Big picture, there remains all sorts of issues, but I think the US might continue to positively surprise.
What about the jobs market in the US, Nouriel? Do you think that the drop that we've seen in the unemployment rate is something that's more than just weather?
Well, I'm a little bit more skeptical. I think, yes, there were 200,000 jobs created per month, but one interpretation that's been indirectly supported by Ben Bernanke is that there was overfiring during the financial crisis. Now there is overhiring, and if economic growth is going to stay below potential, and I'm tracking more of a 2% growth for the US this year, below a potential of closer to 3%, eventually then job creation is going to slow down, and unemployment rate is not going to fall.
I'm just going to have to cut you off there, so sorry. Nouriel Roubini, thank you very much. Jim O'Neill, thank you very much. Guys,
Pleasure.
back to you in the studio.